Thank you so much for your time today, Dumebi. And let's get to what was seen play out, especially what we saw play out at the OMO auction and how foreign investors are taking their positions.
Good afternoon. Thanks for having me. So the OMO auction yesterday, we saw rates being maintained at the short end, mid-term to long end of the curve. We had rates at 7%, 8%, and 10.1. Only a total of 100 billion was mopped up. However, today we had a CRR debit of about 200 billion industry figure. So FPIs are not really comfortable with this current rates, as we all know, or we are all noticing in the market. We're seeing rise in U.S. Treasury yields. The bond yields are up about 2.8 and still going up further. And other countries too, they are seeing yields go up further. So they are not comfortable enough. They want the CBN and they want the market to be able to hinge up a bit. We've been at 10.1 since the beginning of this year, since February, when they moved from 5% from the long end to 10.1. So it's been like this for a while. The CBN is comfortable mopping up liquidity at these levels. However, the FPIs want more because we are moving towards from a low yielding territory to now higher yields right now in the market.
All right, but maybe when you look at how the market has played out this week, how has the sentiment been in terms of yields for investors, and what do you make of the T-bills auction calendar from the DMO?
Okay, so in the calendar from the DMO, we saw 570 billion being offered by the DMO compared to 850 billion offered the previous quarter, Q1. This Q2 was seeing 570 billion being offered. However, as we noticed in Q1, in as much as they offered 850 billion, they still borrowed more. And this 570, there's a likelihood that they will still borrow more with the Sukuk bonds still with the long end bonds still up for grabs later in the year. So with this 570 billion being offered, well, I would say that there's still likelihood for them to increase, as we saw in Q1. Despite the offer 850 billion, they still sold more. So with this 570 billion, it's just a markup to see, okay, this is what they plan to offer. However, there's still room for them to offer more. Mind you, beginning of February, during the general call by the demo to the market, it was credited there to get us out of this effect of the pandemic that they might need or they would need to borrow more.
All right, but we've seen how liquidity has been a major factor in the markets so far, but I would like you to speak to what your expectations are for system liquidity going into next week.
Okay, so next week is going to be an interesting week. For next week, we have an MPC meeting on Tuesday, and at the same time, we also have a bond auction the next day on Wednesday, where the DMO plans to offer 150 billion on the 2027, 2035, 2045, and 2050 bonds. So we expect the MPC, from our views right now, to maintain. Although we see how inflation is up at the 3-month high, unemployment rates are up too, but judging fully well where we are at economic growth, it would not be right, or it might be worrisome for the CBN governor to increase interest rates right now, knowing fully well that we're just trying to get out of the recession. And we might probably see other orthodox means to more or less stimulate the economy. The CBN might take the route of maybe reducing CRR debits going forward to more or less put money more in the bank's hands to borrow more. But an increase in rates is unlikely for us to see. At the bond auction, to make our youth attractive, as I earlier mentioned, we're seeing youths go back to where they were coming from in 2019. In the US, we're seeing youths go up in their fixed income markets, other emerging markets like Tunisia, Ghana, and the rest. We all see rates going up. So other emerging markets in our basket of countries, if you look at the main countries where we have Mexico, Indonesia, Nigeria, and Tunisia, we have one of the lowest youths in that basket of countries. So we might see an uptick in youth in the bond auction next week, and the MPC might hold rates and probably look for other means to more or less curb or find a way to get us out of this effect of the pandemic, and further look for other ways to get us out of the inflation, galloping inflation while we're witnessing. Probably a a change or a movement towards more unorthodox means to sustain the economy.